Welcome to the All Things Wildfire podcast, where we delve into the latest trends and hot topics in protecting properties against wildfire. So sit back, relax, and join us as we arm you against disaster.
All right, everyone. Welcome to another episode of All Things Wildfire. And today, I'm always excited. I'm always excited when I'm getting a new guest on. But when I hear some of these stories, I'm like, okay, I need to have this person on. And this is one of those moments where after we were talking, I'm like, okay, we definitely have some things in here that, Grant, I got to get you on. So let me introduce Grant Staking with Greenspan Public Adjusters. And guys, we're going to dive into some of his experience and what he's done and some of the things to look out for when you have gone through a wildfire. But Grant, why don't you introduce yourself and let us know what you do, what you have been doing, and how you're positioned here to help homeowners with wildfire.
Sure. Yeah. So my name's Grant. Thanks for the intro. I'm a vice president with the Greenspan Company Adjusters International. Greenspan's been around 77 years. We've been helping homeowners and businesses prepare, present, and negotiate insurance claims. Before I was at Greenspan, I was a broker on the retail side and also the excess and surplus line side. And that's where I learned and kind of developed the technical skills to look at a policy, understand how it's supposed to be triggered and respond during a claim. And I made the switch over to Greenspan because I felt like advocacy was more in line with what I wanted to do. And really glad I've been here. I've been here 6 years now. I've been involved in hundreds of claims, over 10 wildfires.
Wow.
So I've seen what happens to communities. I've seen how people do rebuild their lives, and it's, we see them in their worst moments, but also some of their best moments.
Got it. Grant, let me just ask you really quick on the excess and surplus lines that you worked on before as a broker. Like, what kind of experience did you have there? And two questions: what did you see? What do you see now? And having that kind of experience, what do you see now with the current insurance and wildfire industry on what the excess and surplus people are doing? Because, brother, to me, it feels like there's a lot of work on that back end that's having to be done to get to the front end, which is, hey, Mr. Smith, here's your policy. And can you explain a little bit about how that kind of surplus lines and excess surplus, how do they work?
Well, what I'll say is this. I learned a lot about different layered coverages while I was doing that. And to answer your question on the market, I don't sell insurance right now, but you can talk to any agent and broker now, and they'll tell you that this is the hardest market in a generation. And what I have been seeing, especially since I would say 2017 with the Sonoma wildfires, that the policies just haven't, they've been lagging in terms of coverage. I would say 70% of the people I run into are possibly underinsured. And not 70%. And not, your viewers can Google that number, right? The underinsured problem in America, right? We have one. And it's not just underinsured by 50 or 100,000. Sometimes it's 500,000. Sometimes it's 1 million. And so you have these layered coverages, but they're also extremely expensive. I spoke to a lady in Napa. She came to me. She was a former client. House burned down. Instead of rebuilt, purchased a new property. She has a 7,000 square foot home in the Napa foothills. She can't find insurance through Chubb, AIG, privileged underwriters. She has to have all these layered coverages, and the premium's like $120,000 a year. She's like, I'm just not going to pay it. Well, that's a risk you take. So what I've seen is you have an underinsurance problem, but also if you were properly insured, let's say in the foothills where a lot of people are potentially on fixed incomes, they're not going to afford $15,000. For a 2,000 square foot home with a couple that's on Social Security in Mariposa, California, and they live there because they want to be in the outdoors close to Yosemite, they can't afford $15,000 a year, even with the FAIR plan. And I've met these people because I was involved in the Mariposa wildfire, and I would say 30% didn't even have insurance, and the house was paid off, but they didn't even carry insurance because it was too expensive.
Man, I gotta tell you, like, that's the scary thing, man. When you talk about home ownership, and you live in the wildland urban interface, right, the WUI, and you've been living there for 20 years, and now in the past 7 years for sure, there's been increase after increase after increase, and now, like, you're so vulnerable as a homeowner to have been living in this place, and now the premiums are out of control, and it puts the customer in a corner, man.
Well, and just to also, I want to say somewhat fair to the agent, broker, and the carriers, the insurance companies. A lot of these insurance companies are leaving the state because they can't get rate as well. And so we do have an issue where, we're losing markets because, carriers aren't able to, in their view, get the proper rate. And so it's something that I think, both sides need to figure out a solution for. And it's affecting wealthy people. It's affecting the middle class. It's affecting the working poor. So there is a solution out there. And the people in Sacramento need to figure it out, not to get political, but it's affecting everybody in the state.
It really is. It really is. And so, thank you for sharing that. I do want to jump into, like, now you're a public adjuster. And for those listeners and viewers that don't know what a public adjuster is, how would you describe what a public adjuster is and what they do when they're working with a homeowner or a client?
When the situation makes sense, we get involved to help facilitate the insurance negotiation. So your insurance company will send out their experts, an adjuster, a contractor, maybe a structural engineer, a company to do your personal property and contents. They have a team, and we believe that in many instances, you also need your own team to look through this claim through your lens, and somebody who's incentivized to optimize your claim, not only getting you the maximum amount of recovery, but also saving you time and stress. A lot of our clients, OB, it's not always, hey, get me the most money. A lot of times it's they don't have the bandwidth or capacity. They have 3 kids, they run their own medical or law practice, or they work and they have an hour and a half commute. They don't have the bandwidth or capacity to deal with this. And what I see, and this is where I think everybody can do a better job on the carrier side and our side. When I get involved in a claim, I don't look at the carrier, the insurance company, in an adversarial way. I look at it as a partnership where we are going to get involved and find a solution for your insured. Let's get after it. And so I actually have some relationships on the other side, so to speak, that when we get involved, they say, "Thank goodness you're here. This claim's going to require a ton of documentation. I just don't think the homeowner or business owner's up for it. They're going to need another forensic accountant. They're going to need their own experts. And we know what Greenspan brings to the table. We appreciate you being here. Yeah, let's come up to a quick solution." Now, there are points of discrepancy. There are pitfalls, shortcomings that we all have to negotiate. That's why we're here. But ultimately, we view it as a positive interaction with the insurance company. And I want homeowners and business owners to know that we don't get involved to kick the door down.
Yeah.
Yeah.
And I'm glad that you shared the description the way you did. I think too often, look, I'm one of those experts, right? They get called out by the insurance companies. Allied Restoration goes out. We provide an estimate for what it's going to take to rebuild. And to your point, there are some times where the homeowners or the family is so overwhelmed that they're not able to move the needle as quickly as they need to during the claims process, and they almost get stuck, right? Or have this ability to just say, I don't want to deal with it. And to your point, we do have some of our brokers that actually call Greenspan and say, hey, I referred my customer to Greenspan because they can't handle the claims process. And so now, so I think there's room for these types of businesses and these types of services that you guys offer. For the most part, outside of Wildfire, okay, because I want to dive into Wildfire specifically, but outside of Wildfire, if the carrier's doing a good job with communication and the person doesn't have any policy issues, for the most part, the insurance carriers are doing a great job in making the homeowner whole. What I want to talk about is specifically Wildfire. You and I talked about some stuff that I wasn't aware of that I think everyone needs to be aware of, especially if you live in the WUI like I do. It's one of these things that I never really thought about, the underinsurance, the lack of insurance that I have, where I probably need more. But let's unpack the experiences that you've been through and what homeowners have been through and what you've seen with what you're calling the demand surge, right? Yeah. To me, I'm like, what's demand surge, right? And you kind of know what it is by the term, but the reality is that you're seeing it, boots on the ground. Here's what's happening. Here's how my homeowner is suffering, and here's how there isn't enough money from the carrier to make that happen.
Yeah. So, and this is where we disagree often with carriers. They have a certain position on demand surge, and we have a different position. Demand surge is when, let's say, a neighborhood goes up in flames, 1,000 homes burned down, and you now have an increased cost of construction because your framing teams are going to be coming from out of town, sometimes out of state, and you're going to have to pay them per diem to stay in their hotel rooms 3 meals a day and then fly back home to see their families on the weekend. This is a real thing. And so if that's happening, that's the true cost of that framing crew. Now, in Xactimate, which is the software system used to estimate that you're familiar with, there's not a single line item in there for demand surge. And you type, historically, like in Santa Rosa, I believe it was 37.5%, which is
really increase.
Increase, yes. We had framers coming from Arizona. We had framers coming from Reno, construction crews from San Jose. That it's more expensive to build in San Jose than it is in Sonoma County, even though Sonoma County is expensive. And you can't just put in 37.5%, click enter, and it populates all the numbers. So we have to, in a way, bend or manipulate that software system where we may put in something for supervision. And the adjuster from the insurance company will say, this project doesn't need supervision at X amount hours at this rate. And we're saying, well, we're coming up with this figure because we know that at the end of the day, it will cost X amount in increased construction to rebuild. Now, insurance companies will take the position as, well, that's a soft cost. We want our insureds to incur that cost before we just pay it out. And that's fair. I mean, nobody in their right mind would just give an extra $300,000. But when you have 1,000 or 3,000 or 5,000 homes burned down, you also see that these projects take 3 years to rebuild because homeowners don't have $1 million just in their investment accounts or in their bank where they can pool money and build a project. They want to wait for the insurance money to come in. And so they're saying that the insurance company, since it's a soft cost, you have to incur that. The reason we get involved in these claims is we want to leverage our experience and our technical skills, our previous case studies, case law that we see, where we can leverage that and get as much money on the front end so there's less to negotiate on the back end. This way, the project is able to move forward and it's not going to take 3 or 4 years because, as you know, for the loss of use, 3 years, if the carrier considers you to have 36 months, after 36 months, you're out. So
So really, hold on, brother. I want to unpack a few things here, man. Okay. So I'd like to have you use an example of a house or a property that had X amount of dollars in policy coverage, and then what you had to do, like how did you bridge the gap with this demand surge conversation, but then also like if you can define what soft costs mean on the insurance side. Some of the listeners don't understand what the difference is and why would that matter, and why does the insurance company not just pay that because they know that these bids are coming in at higher prices? Why is that considered a soft cost? Why would they pay that later? Can you kind of unpack that?
I may answer this question in reverse. One of the things that I see is when you have a large event in California, you get these adjusters called CAT adjusters, right, for catastrophe. And they're leaving their families in Oklahoma or Texas, and they're coming out to California. One thing I notice is they don't fully understand the insurance code. So they may depreciate certain items that shouldn't be depreciated, right? So that's just one example. They also get a rude awakening when they find out what the cost of construction is in this state. What would you say in Newport Beach is the price per square foot to rebuild on just a home built in 1985 that was custom back then, hasn't been updated? I mean, are we at 500, 600, 700 a square now? What are we?
No, we're higher, bro.
Exactly my point. So somebody coming from Oklahoma sees this house, they say, well, okay, I know it could sell for 5 million, but to rebuild this, you're looking at 350 a square. And we're just like, there's no place in California that you can rebuild for that. So that's what I see. So when they run these estimates right up to the limit in these wildfires, let's say you have $1 million in coverage.
Okay.
You have a 50% extended replacement cost on top of the base limit, which means you have an additional 500,000 for your 1.5. Okay. They'll run the estimate up to 1 million, just under, and they'll release an undisputed amount. And, we sit there and say, clearly this loss is going to exceed 1.5. Why are we just releasing a check for coverage A for that first limit and not just going through the extension? And that's where they say, well, the extension, they have to incur it. That's the soft cost. It's not guaranteed. We'll give them the policy limit. So some carriers do that. Some carriers only provide 30% advance on the structure. Okay. So
really quick, if I have $1 million policy, then I have this 50% of extended coverage, right?
Possibly.
Okay. So if I have that and I have $1.5 million in coverage, and I get like the restoration vendor or the contractors are like, bro, you're at 1.75. Like that's the lowest price of a contractor to take care of this. And if I submit the 1.75, you're saying they won't pay the 1.5, they'll only pay the 1 mil and then wait for me to incur the costs on the other?
That's what we see. That's what we see a lot. They have to incur the cost. And these are in major events. These are 1,000+ homes. And I'm not sure when the last wildfire in Southern California was that took out 2,000 or 3,000 homes, 4,000 homes. But these are events like Sonoma County where 6,000 homes burned down, Paradise where over 10,000 structures. And that's what happens. They control that flow of money, and it gets homeowners really, really frustrated. There are certain policies out there, like USAA. It has a destruction clause in there that if your home burns down, they'll give you 100% of your limit up front, but they won't give you the extension. Again, you have to incur it. So at least they're getting their base limit. But again, if this is going to be, if they have 2 million on the building and they have a 50% extension, which gives them another million, they have 3 million. They're getting that first 2 million up front. That's good. But we know it's going to be 3 million, and you have to fight for that. You have to perform. You have to incur the cost. You have to show through Xactimate that it's going to be this much, because carriers won't take a time and materials estimate. right? You operate within Xactimate, so you know what goes into all that detail. So with that software system, you have to go in and look at each line item and increase costs here or there to reflect that demand surge. I do want to point out real quick, Opie, that while we are talking about wildfires, one of the major issues I've also been seeing is coinsurance. And for your viewers who don't understand, coinsurance is an often misunderstood and possibly misrepresented coverage. It means that you have to carry a certain amount to not be penalized. You're sharing the risk.
Okay. Can you break that down a little bit? What do you?
So like a lot of policies, especially on the commercial side, have 80% or 90% or 100% co. So if you have an 80% co-insurance clause, you have to carry 80% of the value of the rebuild costs. If you don't, you'll be penalized. And what I'm seeing, and I'll do a quick example on the calculator real quick. So what I'm seeing is this. In a wildfire, if it's a total loss and you have co-insurance, penalties not triggered. Here's where I'm seeing the problem, because again, earlier we talked about policies lagging in coverage. Let's say you're in Chico, California, and this is a real example. You're in Chico, California. Paradise is about 30 minutes away, right? 30 miles, 30 minutes. Paradise burns down, 10,000 structures. So in Chico, let's say your building value was at $1 million. Well, you had 80% co-insurance and you were insured for 800,000. So you're in that area where you're fine. But let's say you have a loss 3 months after Paradise. It's not a total loss. Let's say it's $500,000. You have 800,000 on the building as we established. But now because of the demand surge in Paradise, the cost of construction for your building is now 1.5 instead of $1 million, because the 800,000, that was the 80% of the million. So you had 800,000. So the equation is you do 800,000, what you divided by what you should have, which is now 1.5 million, gives you 0.53. You multiply that $500,000 loss to your building, you're only getting back $266,000 instead of your $500,000. So because of these events, people who have these co-insurance policies may not be thinking, well, I'm not in that event, it doesn't affect me. A wildfire 30 minutes away absolutely will affect you. And that's why, I come up with this term. I'll take credit for it. You may be properly
You'll take credit for it?
I'll take credit for it. You may be properly insured today, but underinsured tomorrow.
Yeah.
Because if there's an event and 1,000 homes burn down, immediately the cost of construction goes up in that perimeter, 30 miles, 45 miles, whatever it is. And so if you have co-insurance, it's a problem. And everybody listening to this should reach out to their agent and broker, ask, do I have co-insurance? Ask, should I be insuring my house or my building for just if I had a fire or if the whole entire area had a fire? Because if I'm not keeping up with the whole area, I'm underinsured. And that also, we may talk about this later, but that's where I see communities change after a disaster.
Man, we were talking earlier about Malibu. When Malibu went down, we had the scenario that you were just painting earlier. Contractors from out of state, everyone is here, and like it was like the swarm came in. They're trying to help as many people as possible. But now, what has it been now? 4 years, Vince? 4 years later, whatever that is now. You still only have 30-some% of the homes that burned down actually got rebuilt. And, an outsider is like, why is that? Do people just not want to be here anymore? But now you look at some of the back end things that you're discussing, it's a different reality. You may not have enough money to be replacing the home you had before because of stuff like this demand surge. Things are a lot more expensive. Contractors are not available. So I think this creates a massive opportunity for insurance brokers, insurance agents to really, spend some more time educating the client. And I think the tough part, Grant, is that right now you have homeowners already upset about inflation. They're upset about the economy, and now the insurance rates keep going up, man. Like, what's next? And so they're not necessarily excited about trying to understand how they can be more covered. And if the broker's going to come in and say, hey, Mr. Smith, it's a good idea for you to increase your coverage, and here's why. It seems like it's a tough conversation, but man, if you're an advocate for the homeowner and you're a trusted advisor, even bad news has to be delivered, because that way you're doing your part to educate your customer, your homeowner on, I'm looking out for you. Here are some options. Here's historical data. What would you like to do? And leave it up to them.
It's a conversation worth having, and it doesn't even need to be hard. It's like, look, based on the current economic conditions, this is where you need to be. I just want to let you know. And what I've viewed, homeowners and businesses, they can take hard news. They don't like surprises. That's what they don't like. They don't like surprises. And that's where, there's a psychological effect with these wildfires that I've seen. And like I said, I've been involved in 10. If you have a large amount of people underinsured, if you have an elderly population that wants to move out of California, let's say, and maybe retire, they can take the cash out value of the insurance proceeds and buy a nice home in Florida or Las Vegas or Arizona, wherever. So they're not coming back. The people who are underinsured aren't coming back. The people who are building, it's going to take a long time. There will be people who don't want to rebuild simply because the beauty of that neighborhood is gone. All the trees are gone, the landscaping, everything. I mean, it looks like a bomb went off. And so they're not going to move back. So you may only have, with 1,000 homes burning down, you may only have 400 coming back. And what ends up happening at ICE is there's a big land grab. Developers come in, they purchase land, and it really changes the demographics of the community. And I think that's a lost point that isn't talked about enough. And it starts with being properly insured. If people were properly insured, more people, I believe, would rebuild. But because they're not, these communities change forever. Someplace like Paradise isn't going to recover for 20, 30 years, perhaps. And you'll have new people moving in, but a lot of people didn't rebuild. They didn't have the funds. So, that's what I've seen in these communities as well, is there's this large land grab, and communities change sometimes forever.
Man, it's interesting. I'll give you kind of a personal story of mine. We do wildfire damage repairs, and we do wildfire prevention. And I do want to touch on that also. But it's interesting that you say that the neighborhoods change, the community changes, the people, right? The neighbors they're gone. Some of them come back, some of them don't. There was a fire here probably about 7 or 8 years ago in our local mountains in Anaheim. And a year and a half later, I sent a letter to 20 homeowners in that community that haven't built back yet. I'm like, why are these homes still sitting here, these lots? And part of the message that I wrote in that letter was, hey, Mr. and Mrs. Smith, you might be struggling with the insurance company. It's been over a year, and you're probably wondering if you should rebuild or not. And here's something to ask yourself, because I was writing the letter to purchase the land, okay? And I said, you want to ask yourself, do you really want to come back to this neighborhood? And if you do, rebuild definitely, and make it happen. But you want to ask yourself, how many of your neighbors are actually coming back? What's the landscape going to be like? Is it going to be the same? And Grant, I was just writing it from my point of view, like, hey, here's what I see. But the reality is that hit home. And this customer called me and says, hey, OP, I think I want to leave. what can you do? And we ended up talking, and I ended up buying that one piece of property. But she mentioned to me that they were very concerned that most of the homeowners were not going to come back. Those 4th of July block parties they had are not going to be the same. It's right. So all these things change, and it's things that people don't think about. But if you have the right amount of coverage, you at least have options. Right. And I hear your stories. I'm like, man, that homeowner doesn't have any options. Like, it's either leave or so the flexibility is not there. But if they have the right coverage and the right policies, they have more options for sure.
Well, and that's, when we're not out there advocating on behalf of the policyholder and, making sure we're optimizing the claim on their behalf, we're doing stuff like what we're doing today: education, outreach. I talk with agents and brokers. I talk with property management companies about these very issues, because it's important on a community level that a community is protected. Yes. Again, it's not just about the individual homeowner. These fire safe councils, I think they're great ideas. And one of the focus should also be is, what is the community plan if something were to happen? What do we do as a community? What are our options? But let's have some accountability within our community to just make sure that, we are, being properly insured. We are looking at our exposure and things like that. It's really, really important. And again, it hits home for me. I've been evacuated 4 or 5 times in the last 5 years.
Oh, okay.
When those
normal for you.
Winds come up here in Northern California and it's 105, these fires go from 500 acres to 50,000 in a day and a half. It's crazy.
Wow. Now, Grant, let's talk about wildfire prevention. Okay. Like, that's been a big push from California in the state, and they're investing money to try and help homeowners harden their homes, manage their vegetation, and really like minimize the amount of damage that wildfire does to homes. I've seen it firsthand, but have you seen carriers send letters to customers saying, hey, do these things or we may not be able to insure you?
Yes, I've seen that. I've seen that carriers will offer a credit if they do it as well.
Really? Okay.
Yeah, I've seen a credit. I don't know. I can't tell you how much it was. But I don't think the credit offsets the cost.
Yeah.
But look, if for many people, their home is their biggest asset. Some people look at homes not as an asset, but a liability, right? We can talk about that.
Robert Kiyosaki, yeah.
yeah, exactly. But it makes sense to be proactive, to harden your home and do those things. But yes, I have seen insurance companies, especially California Fair Plan. Fair Plan will come out and say, you need to do this, you need to remove this tree, you need to,
really
look at this deck, it's hanging over. We're not insured. So yeah.
Got it. Okay, cool. Now, recently we have an affiliation with IBHS, the Insurance Institute for Business, Home, and Safety. And they've done massive amounts, probably the most amount of research than any other research company on the impacts of wildfire and embers on a property. And so they have these qualifications on what's called Wildfire Prepared Home designation and Wildfire Prepared Home Plus designation. And what's really interesting, Grant, is that we just helped a homeowner in Malibu get the Wildfire Prepared Home Plus designation. And what was interesting is the carrier said, if you get that designation, we will insure you. If you don't, we're out. And so it wasn't an incentive where we're going to give you a discount. It was like, we're going to go ahead and write you, But But I think some of those things are more and more coming down the, through the pipeline on some of these things. And it's really cool because, when I think about some of these massive events that you get involved with or that I get involved with after the wildfire, if a homeowner or if a home has partial damage, that's much easier to get through the process versus an entire home that burns down to the ground. Now that's from me. That's from my standpoint. I don't know how you feel about that.
Well, I would say it depends on the different factors. If your home burns down to the ground and you are massively underinsured, maybe you will get your policy limits much sooner. Where in a regular day-to-day fire, you have a kitchen fire, it guts the first floor. Now you have to go through discovery and, did the smoke travel through the wall cavities? Is it upstairs? Did it get in the attic? Do we have to rip out the ceilings? And, what's the scope of work going to be? Yeah. But no, I get your point. For me, it depends on the factors. I'm a big advocate and proponent of harden your homes, get it done. Just like having insurance, you can at least sleep better knowing you're covered. Same thing, when these winds pick up and these embers can travel 2 miles, if you have frost check around your property, it works. It's going to slow it down. The question is, will the fire department get there in time, right? Or a helicopter drop and water right by your property. Everybody should be hardening their homes and being proactive into protecting their property.
Yeah. And I think part of what I was thinking is if someone has put ember resistant vents or 16th inch mesh to prevent embers from coming into the attic, that's a big plus. If they put gutter guards on so that way debris doesn't mount up and we don't have flames in there, that's a plus. And if they're able to remove vegetation away from their home at least 5 feet away, those things help prevent massive damage. And I don't know if you saw, Grant, it was the coastal fire here in Laguna Niguel about 1.5 years ago. Yeah. Right? The hillside is burning and these homes are sitting on the top here. And what was so interesting to see is that even though the home's sitting here and the hillside's burning, the homes inside, like a block or two in, were actually on fire, and the roof is on fire. There's nothing else around it on fire, and it's because these embers entered into the attic and began to ignite, combustible materials in there, and it's over.
For in many instances, it's preventable, right? Yes. In other instances, in something like Paradise, it's not going to happen.
Yep.
Everything's burning down.
Yep.
But absolutely, I mean, it's preventable. And then if you're taking responsibility as a homeowner or property owner, and you're protecting your home, you're protecting homes around you.
Yeah.
And it's that's why it's a community thing. I mean, we all have a role to protect our neighborhoods, just like you have those signs that say, you walk around looking for suspicious activity. We should have neighborhoods that are resistant to fires, and it's a community thing. So
that's interesting you say that. I was on a podcast with an HOA podcaster a couple weeks ago, and that's so true. Even in my community, I have this app that we use that if there's suspicious activity, people are commenting on that. It's not next door. This is, I forget what it is, but yeah, some of those are kind of weird where the people are just super like, why am I even in this conversation? There's so much drama. But to your point, if there's an awareness of wildfire prevention, if you see, shrubs that are just completely dried out, they're up against the home, and with our communities, like we're like 5 feet apart from each other, right? And so my home is definitely going to have an impact on my neighbor and vice versa. And so I want to make sure that we're both, doing what we can to prevent some major ignition. But I think you're right. I think on a community level, there has to be more awareness on what people can do individually to help themselves, their neighbors, their block, and their entire community. Speaking of that, and you said that you guys do some outreach and stuff. When you guys are out there talking to people, like a wildfire just broke out, what message are you guys delivering to customers that may raise their hand and say, hey, I could use your help? Like, what does that look like when a wildfire just came through the neighborhoods and you're out there having these conversations, either on a community level or individual level with customers?
So on both the individual and community level, it's all about education. This is not about getting involved right away. This is about looking at everybody's individual circumstances and educating them on their policy. And so we'll hold town halls, webinars, and then individual meetings as well. It's like, look, we're going to go over your policy and we're going to show you where we believe everything should respond and how it should respond. And if the insurance company, for some reason, deviates away from that, here's how you push back. So even if we meet with them, or when we meet with them, we're still giving them the strategies that they would use if they hired us. So it's about education. Now, a lot of people say, okay, but you can do this for me, right? And we're like, well, sure. But really, it's coming from a position of just educating them and letting them know what they need to do as the policy holder to optimize their claim. Sure, we can do that. We have, like I said, in-house experts from forensic recreation specialists on your personal property, where we can also price it. We have our own team of adjusters who, by the way, a lot of them used to manage adjusting teams for insurance companies. We have building experts. We have attorneys in-house. We do not practice law. I want to be clear again, we do not practice law, but we do rely on their background when it comes to certain type of claims. And if they need an attorney, we refer them outside.
Got it.
But yeah, I mean, so we're able to negotiate that claim, understand what needs to be done day one, and we give them that roadmap of here's what it's going to look like, whether you choose to go with us or whether you choose to do it on your own.
Got it. And Grant, if someone decides to hire your firm or a firm like yours, Public Adjusters, what's it costing them, right? We haven't talked about that. What does it cost me as a homeowner to say, okay, I'm going to hire this expert now to essentially represent me and do all my paperwork and handle my headaches with the insurance company. And if the firm is trustworthy, I'm going to do it. What's the fees? How does that work? What does that look like?
Our fees 10% from $1, and we don't cost anything. And the reason I say that is we're an investment. Our return on investment, we have metrics where we track this, and we have references and people you can call, say, hey, I know Greenspan got involved in your claim. I just had a major fire. We've tracked it. Our ROI is anywhere from 40 to 70%. So we make a big difference. And part of that is the demand surge argument. Some of it is fighting on depreciation when it comes to the home or personal property. Sometimes it's finding hidden coverages within the policy, and that we can make argument to claim more. So whether it's trees or shrubs or other structures, code upgrades, law and ordinance, there's most policies have 10% for code coverage, but that doesn't mean you're going to get paid for what it actually costs to bring your home up to code. I mean, you probably had those issues where, hey, this sprinkler is going to cost this much. Why aren't we getting this? And so yeah. we make a difference by chipping away at that policy. And like I said earlier, I mean, there's an underinsured issue. We just don't take on clients who are underinsured. If I know you're going to,
if you have a homeowner that has $1 million coverage cap, and they have $1.5 million of damage, like that would cost them, $100,000 to hire you.
Possibly, because look, and I know where you're going with this. It's a good point. It's not guaranteed they're going to get the 1.5. We talked about that. It's not guaranteed they're going to get it. So everybody on our team is very open and transparent and say to the homeowner, look, your loss is probably 1.5 million and you have $1 million in coverage. You may be able to get it all on your own. It may take you longer without us, but I want to let you know you're underinsured. They'll say, it doesn't matter. I don't want to deal with this. I have too much going on. Handle it for me. Then we'll figure out how to do that for them. That makes sense. But again, if they're insured for $1 million and they need $2 million, a lot of times we'll sit down with them an hour or two, as long as they need, and we'll still give them that strategic path going forward so that they can deal with the claim on their own. And all of our team members, once we have that meeting, we are now a resource really for life. That person in 6 months may call back and say, I'm doing everything. I still don't have all my money. Can you come on board? Or they'll call back and say, hey, I have a question. We'll answer the question and we'll push that over the finish line for them at no cost. But yeah, so our standard fee, it's 10%, typically 40 to 70% more than what they get on their own. We have the metrics to show that. And clients and referrals. So anybody can call our references and find out exactly what we did for them.
Yeah, I think for the homeowners and people listening, if they have a limit on the policy and it's very clear that there's no additional code upgrade or no additional money to be had from the carrier because of the policy that you purchased, hiring someone like you is basically throwing a little bit more money away, in my opinion, right? And this is what I want to make sure we're clear on. If someone's underinsured and there's nothing you can do to help, you're just going to give advice and go, hey, Mr. Smith, good luck. I can't take your money. You don't have any.
We get a lot of free advice. I'm still getting calls today from the Paradise wildfires where they're underinsured. Wow. They still don't have all their money. We don't get involved, and I spend an hour on the phone with them just to give them advice on what kind of coaching through. Yeah.
Now, no, and I appreciate that. I think that's where everyone needs to realize before, because look, selling the policy is one thing, and that's your brokers, your agents, and they're building relationships to give the customer what they need. The handling of the claims process is a whole nother situation. And that's what I see. That's what you see. We're able to see the ugly, the dirty, the not so pretty stuff that goes on and jumping through hoops. But I want to touch on the different types of buckets within the policy, right? You got contents, you have structure, you have ALE, you have your code. Can you kind of break that down, describe it for listeners as to, now that you have a claim, here's how the buckets are divided. And so they can start to do some research on their own, maybe call their broker and talk about like some of these areas can be raised up.
So your coverage A is typically the structure. And that's the limit you have. Let's say it's $1 million. You then have your coverage B, which is many times your other structures. Other structures is often 10% of your base limit. So if you have $1 million on coverage A, 10% coverage B, you have $100,000 for your other structures.
Now, really quick, the other structure has to be detached from your home?
Well, that's what I was going to say is, okay, what are other structures? It's your pool, it's your decking, it's retaining walls, it's a shed or an outbuilding, has to be detached. It's your fence. It's your deer fencing. If you own, acreage, that, and this is what I was going to say about your other coverage. That 10% is not enough. Standard, it should be 20%. You have to talk to your broker about it. Here's why. Let's say you're in Southern California, okay, and you're insured for $2 million on your home, and you have 10% in other structure costs. You have $200,000. Opie, how much does it cost to build a pool in a backyard?
Probably probably $400,000, man. I'm telling you, like, I just got quotes recently. It's ridiculous.
I just put one in my backyard.
Okay. What did you spend?
Yeah.
What did you spend?
Too much.
Too much, yeah.
And here's the thing. So if there's a wildfire that comes through and you only have 10% to cover your driveway, the fence alone around the property might be 50, 60,000. So now you have 150,000 left. You have a $300,000 pool. Now you're $150,000 in the hole, and you still haven't done your driveway. Wow. You still haven't done any outbuildings or anything. So that 10% is often too low. People should talk to their agent and broker about increasing the base limit on coverage A so that your other structure goes up with it. Or can they get the other structure alone up to 20 or 25% instead of the standard 10? The next one is coverage C. It's typically your contents or personal property. I say best practice is to have anywhere from having the coverage be 60 to 70% of your coverage A. So if you have $1 million, you should have $600,000 to $700,000 in coverage on your personal property. Now people say, I don't have that much, regular middle-class family. I don't have 700,000. Well, if you lived in your house for 15, 20, 30 years, you've accumulated a lot of junk. My garage is full. I could park all my cars in it, but it is full. And so again, best practice, 60, 70% of coverage A. Then your coverage D is your loss of use. This is the coverage that the insurance company pays you to live somewhere else. So if you have, 300,000 in coverage and you need to go rent a place for 8,000 a month, yes. What you want to do is look at that 8,000 a month, multiply it by 36 months for a wildfire. That's how much you would need. Best practice, get a policy that has actual loss sustained for coverage D, not a number.
Okay, hold on. So it's called actual loss sustained?
Actual loss sustained. It means it's unlimited. Now, that doesn't mean you can go rent a place for $50,000 a month, unless that's a comparable home to what you live in. But what it means is you're still beholden to that either 24 or 36 month period, but you won't run out of funds within that. So let's say there's a wildfire and it's going to take you 3 years to rebuild, and you have 300,000 in coverage. What does that come out to? 300,000 divided by 36. I'll do it right now because my math is so bad. So you do 300,000 divided by 36. That leaves you 8,300 a month. Well, there's a lot of homes in Southern California and Northern California that are comparable, that your house would go for 12,000 a month. So if they give you 8,300 a month for rent, it's only going to go through that 36 month. But what if you can only find a place in your area for 12,000 a month? Right. So if you were to do the 300,000 divided by 12,000 divided by 36, now you'll run out of money at month 28. So having the number not be a number and have it be actual loss sustained means that if your house should rent out for 15 grand, you can go out and get something for 15,000, 8,000, and you're not going to run out of those funds. And then you have your code upgrades, law and ordinance, your code upgrades, and that's typically 10% as well. On homeowners, I see that coverage is generally sufficient. Where I see it's not is on commercial properties. They're 10% for commercial, not always enough. And there's things that we do as public adjusters where we can move things around and fit it into code or fit it into the structure.
Yeah. So thank you for kind of laying that out. I think us as homeowners, we need to understand our policies a little bit more, and not necessarily into the minutia, but at least high level. What's my exposure? What is going to be my potential expense, and what can I invest in now to kind of ease the blow if something were to happen. Now, here's what I ran into. When this Malibu fire took place a few years back, I had a a friend of a friend called me and she said, "Hey, OP, I hear this is your industry. You're helping my neighbors. My house is burnt to the ground. I have this carrier, and the carrier told me to make a list of all my contents. And I had photos, but the photos were in my house. And I don't remember anything. I'm remembering things every now and then, and I'm writing them down, but is there an easier, better way?" And for us, what prompted us next to do some really kind of unique things is now we're offering our homeowners that do work with us, however they get involved with us, we're offering these things. We're doing a digital sketch using Matterport or DocuSketch to really scan every single room of the home, and then they can keep that in the cloud. And so if something were ever to happen, now you have automatic documentation of what your home looked like at that time, where you don't have to depend on your memory to write things down. Besides doing some of those things, what would you recommend to homeowners to kind of prepare for some of these things that could happen, where we're left, with just our memory to try and write down what we had so we can get our money back?
The other thing, if you even if you have that service, it's still good to reach out to friends and family. If you've ever hosted a party in your home,
Yes.
Anybody who's taken a selfie, opening presents on birthday parties, that go to a home furnishing store and start walking around, and it'll jog your memory. Look at magazines. We have our own forensic recreation specialists that go through that process with them. And then what we've seen is we've ran into people who have great documentation. They submit it to the insurance company and they still don't get their policy limits because they have to now price everything. And, these people may shop at Neiman Marcus or Nordstrom, and the carrier's finding a comparable item at Walmart. And again, so we see this, and it's a lot worse. It's worse. It's gotten worse in the last 2 or 3 years than I've ever seen it before. Pricing has become a huge topic, where even though, we have, an exhibit, this is it. This is what they had. Here's the price. We sourced the pricing. Here's where we found it. It's difficult for the insurance company to finally come on board. I think they eventually pay it. We've seen them pay it, but it's difficult. So we have our own pricing department.
Challenge. Would you recommend, are you suggesting that when us as homeowners and consumers, we buy a dining room table, some really cool chairs, or, some expensive clothing, that we should keep the receipts? Does that matter?
The receipts, put it in the cloud. But it's important to note that maybe you bought it on sale and that sale no longer exists 2 or 3 years later. So yes, fine, have the receipt, that's fine. It'll get you in the range, but what you're looking for when you're pricing it is current replacement cost value.
Got it.
And then the other thing, Opie, is it's important to understand depreciation. So, in California, and we see these adjusters come in, and they don't know, but it's age and condition. It's not just age. So it's kind of like the tale of the two couches. You may have a couch in the living room and one in the family room. They're both 20 years old, but one's the couch everybody beats up and sits on, the other couch nobody sat on. Their current value is different. And so when you're going through a list of 1,000 items in a home or 2,000 items, and the insurance company is applying 35 or 50 or 60% depreciation, you have maybe, let's say, $2 million in coverage on your personal property, and they're giving you $800,000. Well, that's why, is because they've applied heavy depreciation. So what I tell people is, before the fire, you want to have a team in place, a disaster preparedness team, to avoid the disaster after the disaster. Right. And you want to be able to, and that's a phrase coined by Mark Fratkin. I can't take credit for that one like I did the other one.
Say it again, brother, because I was trying to write that down.
Avoiding the disaster after the disaster.
Yeah.
So you want to be able to control the depreciation on your items, on your home, so that your initial non-disputed check is much larger. And I'm still getting calls. I got a call a few months ago with a woman who lost all of her tack gear, at she had a ranch, like a equestrian, like a horse place, lost all of her tack gear. And every item was just automatically applied 50% depreciation. And at no cost, I went through each item and I said, well, when did you buy this? What condition was it in? And we got that down to about 12.5%. Then it took I wrote her a few letters that she then submitted. There's no Greenspan title on it. I just said, I'm writing this. You send this into the insurance company. It took about 3 letters. And finally, after 6 months, she got another check for like $900,000. No, not that much. Something in the mail, like here, because they revised the depreciation.
Yeah.
So you got to, as a homeowner business, you got to be educated. It's not just about the coverages you have. It's about how depreciation is being applied to your belongings. And if you don't know how to overcome that, you're going to be scratching your head and you're going to be stuck, as you said earlier. It's just like, what's going on? I have $800,000 worth of belongings. You've given me $400,000 and you're saying I have to go spend the $400,000 to get it back.
Yeah.
That doesn't make, so again, you overcome that by depreciation and pushing back. And we do that often.
Wow, man. And I think, as a listener and someone, as a homeowner, I'm like, man, you really need to prepare, not only to avoid wildfire damage, but if you have smoke damage that comes through the house, that's still a claim. You have even some minor roof damage or what have you, like it's still part of the claim. You're still having to be relocated likely. And so all of these things begin to apply. And so, yeah, we have to, man. Look, I think as a homeowner, as a business owner, we need to rely on our brokers, on our agents to really help us understand the policy better. And like you said, have the conversation. And you had said, hey, the hard news is better than the surprise. And that's what clients hate. I'm totally with you, man. They're like, just talk to me clearly, give me my options, and I'll deal with it. But to not have the conversation, and now here's a surprise. Guess what, Mr. Smith? I forgot to, I didn't think you would be interested in this part of the policy, so I didn't even bring it up to you. Now we have a relationship problem because, I thought I had a trusted advisor, and now I just have someone selling me what they think I need versus options.
And that's why I also offer, I do policy reviews all the time. Because again, I look at things different on my end than maybe what an agent or broker does. When it comes to, let's say on a business side, business interruption, they may look at their books and say, well, you need this much coverage. And I'm thinking, well, if you're down for 7.5 months and you move to a separate location or facility and you're running at 40%, and you're not at 100% capacity and, all these different factors, this is what your business interruption should be. So, I look at residential and commercial policies all the time, just because I have a different level of experience. I'm not saying I know more. I just know something else that maybe somebody who hasn't been on the claim side sees. And so for a lot of high profile clients or large businesses, I do those policies. Somebody owns, 30 apartment complexes, whatever it is, I take a look because I see these policies sometimes and they're just not adequate. I mean, I handled a claim, and our team did, for a guy who owns $800 million worth of property. So wow. Sophisticated guy. None of his policies were good. They just weren't. Now I didn't throw anybody under the bus. I just said, here's some changes I would make. But you're right. Agents and brokers really need to educate. I educate them based on what I see. So it really is a team effort, and we should be working together more closely. That way, all of our clients have a better outcome than what they could have.
Yeah. Now, really quick, Grant, in closing here, and thank you for all the stimulation. I got some notes here, but speaking about businesses, we do have listeners too that own businesses, and so what impact? Here's what I'll tell you. What I see happening, and I want to know how you would help, is as a business owner, you have employees that have suffered a loss and they now cannot come to work anymore. You have roads that are not accessible anymore, and so now employees may not be coming to work because they can't access. You have the business now has changed where you can't have, people are not being able to get to your facility because of all these other things. How does that work for a business? What kind of losses, what kind of scenarios in situations have you seen there?
In almost every policy, there's language that says the business itself needs to suffer property damage to have a claim, kind of like with COVID.
Oh, really?
Kind of like with COVID, where you
Yeah.
have this first exclusion. It's like, well, my restaurant shut down. Does your restaurant have the physical loss? Then there's no coverage for the virus. So it's like that. I'm actually not the expert on that piece, only because, again, I don't sell the policy. Maybe there's an agent or broker that can speak to a type of policy that will cover if there's, roads that make it inaccessible to get to work. But what I do on a daily basis is dealing with physical loss. It could be product recall. It can be cyber. It could be a fire, water damage, hail, wind. That's what I. So I don't get involved in something if there is a claim where, the road's down and people can't get it. Now mudslides, that's different. I mean, if a mudslide comes in and it creates, and let's say the mudslide was caused by a fire 4 months earlier because there's erosion and ground's not stable and it comes away, the carrier may deny the claim and say, well, we don't cover for mudslides. Well, it was caused by the fire. We do that. But yeah, if you have 20 workers in this one neighborhood, that work, let's say you work in agriculture and they can't come into the fields anymore. I don't know of a policy that gives that kind of coverage, but that's because that's not what I do. Like, I don't even do crop insurance. I don't touch crop insurance claims, but I do your fires, your product recall, your cyber.
I guess what, as I'm thinking about that, if as a business owner, and if I have to deal with an insurance claim, plus I need to run a business, like my bandwidth now is just like I'm stretched thin, man, because I'm trying to keep the business running. I'm trying to keep my employees. Where are they? How can I help them? What can we do? How can we get to still be in business? So I can see how having an advocate could be beneficial from that standpoint.
I would say on the business front, let's say you do suffer a physical loss. You have a manufacturing facility and the building goes up in flames. Well, now the question is, who's the insurance company going to drop from payroll? Because they only pay essential or key employees. So the question becomes all right, I may have 30 people laid off, but it's going to be really difficult to find those 30 people in 12 months when I'm back.
That's right.
I want to try and keep them on payroll. So for business owners, have written down right now who a key employee is. I think everybody's a key employee. It's tough to hire people and it's expensive to hire people. The insurance company will say, well, that's not a key employee. They're off payroll. You can keep people on payroll if you have the coverage. You have payroll and ordinary payroll. You also have on the business policies extra expense. That allows you to move to a new location and lease a new location if your facility's down. It will pay for the increased costs in production if you have to now outsource your production to a competitor so you don't lose market share. So extra expense will pay that extra expense. There's a lot of things in a commercial policy to look out for. So yeah, for a business owner standpoint, they got to understand how that commercial policy reads, how it's triggered and how it responds. Because again, if you have a fire, that doesn't mean fire everybody day 3, keep them on payroll. You may have a 30, 60, or 90-day payroll, and then key employees stay on. But if you classify everyone as a key employee, you can make the argument to the insurance company, everybody's a key employee. I need to keep them all because it's going to be very difficult to ramp up in 12 months when I'm trying to hire people.
100%.
So commercial policies get really technical. And yes, you need to have a pre and post disaster team in place. That is proactive, especially this day and age in climate change. However you think climate change starts, man-made, not man-made, whatever, disasters are happening, have a pre and post disaster team in place. And I'm more than happy to talk to anybody. And like I said, it doesn't cost me a thing, or it doesn't cost them anything to talk to me. I only get paid on proceeds I collect from the insurance company. So, we have companies who we're already engaged. So when a fire happens day 1, we're already involved.
Interesting. Grant, thank you very much, man. In closing, what would you want to say to the fire safe councils, to the customers, to listeners on their ability to prepare not only for the disaster, but for the disaster after the disaster, because that is unfortunately still very painful. I've been evacuated and I didn't know if my house was going to survive, and I felt this massive anxiety. And then after seeing my house is still there, it's cool. But if it wasn't there, I know the anxiety on the back end because I've been living it all these years. And most people don't know that, right? We're saying it, but they've never felt it. And it's not a good feeling to have to go through the recovery process. What piece of advice would you leave people with?
I would say first, it's important for everybody to understand the market conditions of where you live and be properly insured, not just for your home or business, but based on the overall area. Like we talked about earlier, if another area has a fire, it will affect the cost of construction in your area. So insure your property as if you could be in a FEMA declared disaster, because then you'll carry more insurance. Another one is review your policy twice a year. Every time you push the clock back or forward, that's a good time to review your policy. Just have it be muscle memory. With inflation changing from, every 6 months, so to speak, It could be more expensive. Have a team in place. And I would say if you want to engage a public adjuster, such as myself, make sure that they belong to NAPIA, which is the National Association for Public Insurance Adjusters. They are held to the highest standards of ethics, and it's best to deal with a public adjuster that belongs to NAPIA, and to really have that team in place of trusted advisors. And that's what I would leave with everybody, and that's how you avoid the disaster after the disaster.
Boom. Grant, thank you very much, brother. I appreciate your candidness, your sharing some of the tips that you shared for our listeners. And for you listeners out there, if you see value here, share it. Share it with your friends, share it with your family, because just because you may not live in the wildland urban interface, or you may not be at risk, or you think you may not be at risk, I think there's some pointers here that absolutely everyone can benefit from. And sharing these ideas with our family and friends is going to be important to make sure that we're preparing them as much as we possibly can. So, Grant, thank you very much, brother. Peace out. Appreciate it.
That's all for this episode of All Things Wildfire. If you like this episode, be sure to subscribe to our show and follow us on social media to stay up to date on all things wildfire. And as always, thanks for listening.